The 1920s in America were a time of great change and prosperity. It was a decade marked by a sense of optimism and a belief that the future held endless possibilities. The end of World War I brought a collective sigh of relief and a desire to celebrate life. World War I was over, and a new era seemed to be dawning. The soldiers returned home to a hero's welcome, and the nation was ready to move forward. The economy was booming, fueled by new technologies like the automobile and the radio. Henry Ford's assembly line made cars affordable for the average American, and the radio brought entertainment and news into homes across the country. People were optimistic about the future. They spent their leisure time enjoying new forms of entertainment from jazz music to silent films and embraced a lifestyle of fun and freedom. They embraced new fashions, music, and social trends. Women in particular experienced newfound freedoms, symbolized by the flapper dress and the Charleston dance. This period became known as the Roaring Twenties. Nightlife thrived, with dance halls and speakeasies becoming the epicenters of social life. The stock market became a symbol of this newfound prosperity. It was seen as a way for ordinary people to achieve wealth and success. Stock prices rose steadily throughout the decade. The bull market seemed unstoppable, and everyone wanted a piece of the action. More and more Americans saw investing in the stock market as a way to get rich quickly. Newspapers were filled with stories of overnight millionaires fueling the frenzy. They believed that the good times would never end. The idea of perpetual growth and prosperity became a widely accepted notion. However, beneath the surface of this economic boom, there were warning signs. Income inequality was growing, and not everyone was sharing in the prosperity. Many Americans were buying goods on credit, accumulating significant debt. The culture of consumerism was built on borrowed money, creating a fragile economic foundation. The agricultural sector was struggling. Farmers faced low crop prices and high debt, unable to benefit from the urban prosperity. These underlying problems made the economy vulnerable to a shock. The disparity between the rich and the poor was widening, and the reliance on credit was unsustainable. The stage was set for a dramatic turn of events that would shatter the illusion of unending prosperity. The tension in the air was palpable as the decade drew to a close. The stock market crash of 1929 would mark the end of the Roaring Twenties and usher in the Great Depression. The dreams of endless wealth and prosperity came crashing down, leaving a nation to grapple with the harsh realities of economic collapse. The stock market boom of the 1920s was different from previous periods of speculation. It marked a significant shift in the financial landscape of America. For the first time, ordinary Americans were investing in the stock market in large numbers. This was a stark contrast to earlier times when the stock market was seen as an exclusive playground for the wealthy. Previously, investing had been the domain of the wealthy elite. The stock market was a mysterious and intimidating place for the average person. Several factors contributed to this increased participation. The rapid industrial growth and technological advancements of the era played a crucial role. The rise of new industries such as radio and automobiles created exciting investment opportunities. These industries promised high returns and captured the public's imagination. The media fueled public interest in the stock market with stories of overnight fortunes. Newspapers, radio broadcasts, and even word of mouth spread tales of people getting rich quickly. New investment vehicles like investment trusts made it easier for small investors to participate. These trusts pooled resources from many investors, allowing them to buy a diversified portfolio of stocks. People from all walks of life were eager to get in on the action. The allure of quick wealth was irresistible, and many saw the stock market as a ticket to financial freedom. They saw their friends and neighbors getting rich from the stock market. This created a sense of urgency and excitement, as no one wanted to be left behind. The fear of missing out, or FOMO, was strong. People were driven by the desire to not miss the opportunity to make a fortune. Many believed that the stock market was a surefire way to achieve financial security. Dinner table conversations often revolved around stock tips and investment strategies. However, many of these new investors lacked experience in financial literacy. They were often unaware of the complexities and risks associated with stock market investments. They did not fully understand the risks involved in the stock market. The potential for loss was often overshadowed by the stories of success. They were often swayed by rumors and tips rather than sound investment advice. This led to speculative buying and selling, driven more by emotion than by rational analysis. This lack of knowledge would have disastrous consequences when the market turned. The crash of 1929 revealed the vulnerabilities of these inexperienced investors, leading to widespread financial ruin. One of the key factors that fueled the speculative bubble of the 1920s was the practice of buying on margin. This practice became widespread and was a significant driver of the stock market frenzy that characterized the decade. Buying on margin allowed investors to purchase stocks with only a small down payment, typically 10% of the stock's value. This meant that for every dollar an investor had, they could control $10 worth of stock. The rest of the money was borrowed from a broker. This practice magnified both profits and losses. Investors were able to leverage their positions significantly, which could lead to substantial gains if the market moved in their favor. If the stock price went up, the investor could sell the stock, repay the loan, and make a handsome profit. This potential for high returns attracted many people to the stock market, further fueling the speculative fire. However, if the stock price went down, the investor could be subject to a margin call. This was a demand from the broker for additional funds to cover the losses on the borrowed money. This meant they had to deposit more money with the broker to cover their losses. If they couldn't meet the margin call, the broker could sell their stock at a loss, often exacerbating the investor's financial troubles. If they couldn't meet the margin call, the broker could sell their stock at a loss. This could lead to a cascade of selling, driving stock prices down even further and causing widespread financial distress. Buying on margin allowed investors to control a larger amount of stock than they could afford to purchase outright. This increased demand for stocks, driving prices even higher and creating a sense of euphoria in the market. This increased demand for stocks, driving prices even higher. As more people bought stocks on margin, the market continued to rise, creating a self-reinforcing cycle of speculation and rising prices. It created a dangerous feedback loop, with rising prices encouraging more margin buying, further inflating the bubble. This speculative frenzy was unsustainable and set the stage for a dramatic market correction. While buying on margin can be a legitimate investment strategy, it became excessively risky in the late 1920s. Investors were often over-leveraged, meaning they had borrowed too much relative to their actual capital. Investors were essentially gambling with borrowed money, often on stocks with inflated valuations. This speculative behavior was not based on the fundamental value of the companies, but rather on the expectation that prices would continue to rise. When the market turned, the consequences of this leverage would be devastating. The crash of 1929 wiped out many investors who had bought on margin, leading to widespread financial ruin and contributing to the onset of the Great Depression.